CMQ investors, welcome to the show. This is our second interview, and this is another great interview, another one that I learned a lot from, and I think you'll learn a lot from as well. It's with Nick Maggiulli, who is the author of the new book, Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. Now, Nick has a very popular blog called Of Dollars and Data. He's also the chief operating officer at Ritholtz Wealth Management. If you watch CNBC, you're probably familiar with Josh Brown. Josh Brown's one of the head honchos there, so Nick is in great company. One of my favorite parts of Nick's blog, and of course his book, Just Keep Buying, is that Nick looks at the world of investing, the world of personal finance through the lens of data science. So if you're interested in evidence-based investing or data-driven investing, you have to listen to what Nick has to say. If this is your first time listening to the CMQ Investing Podcast, we have over 90 episodes full of investing wisdom that you can use and apply in addition to this interview. So make sure you follow on Apple Podcasts or Spotify. Check out the YouTube channel, CMQ Investing. And of course, check out this interview in Nick's book, Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. Without further ado, let's get to it. What's, just to get things off on, well, I'm sure we'll have tons to talk about with the book, but I remember, I think when I was getting more and more into this space, you were someone that came up on probably Twitter, and it was a blog post you wrote about a good friend of yours from high school. And I remember, I don't remember the details. I just remember being like, it kind of created like a personal thing. I was like, oh, cool. You had long hair. It was like a picture of you. Mm-hmm. It was, I think it was a female friend of yours.
Yep.
And it was, and then that led me to your blog, because I think that was on your blog. Mm-hmm. And, then I said, oh, this is cool. Because my world is, like I mentioned, data driven. And so I was like, oh, this is a cool way to look at, anything investing, finance, the way you were breaking things down. And I remember reading on your blog, this all started for you as something that, you were just doing that led you to where you work now. Could you just tell us about that a little bit? I think it's a really unique story.
Yeah, so I was an economics major in college. After I graduated, worked in econ consulting, which many of your listeners may not know, or litigation consulting. So it's consulting in the context of litigation. And that's where I kind of got my data chops from. And so I kind of got really into data and stuff, but I always kind of loved personal finance and investing, like behind the scenes, but I never really did anything with that. I couldn't really think like, oh, should I write about this? I still have a notebook from 2014 that I wrote down like every single, like all these blog post ideas, many of them, which I eventually wrote, but I just had the idea and I just, I never went past it. And then finally, like the end of 2016, I'm like, I need to do something else, right? I was like looking at my career. I was like, I just saw like, I was basically like, I didn't see a future there in litigation consulting. So I was like, I love data, but, maybe I can apply data and apply all these skills I've learned the last, 6 years and apply that to, investing. And so let's just see what happens. Right. So I'm going to write a blog post a week and I'm at like post 289 now. So it's like every week I haven't missed a week and 289 in a row. So it's kind of a wild thing, but it's just kind of like, that's just part of my life now. I just do it every week. And it's like, I find time on Saturday, Sunday and just write it up and that's it. So, and that's kind of how I got into it. And I just always loved the space and, love thinking about finance and numbers and money and stuff like that and talking to people. And I do write about personal stuff sometimes, like maybe one in every 10 posts is like a personal post. And that particular post that you remember, just about regrets and stuff. But I mean, I can go into it if you want, or we can kind of stray,
I'll put a link. It was more, and again, it was at the time, I remember reading it and, it was just authentic and for however reason it was recommended to me. And then I don't remember all the details, but I remember enough to where it's like, that made me want to check your stuff out. And then that, it was a really, not to try to get into like the marketing strategy of that. I think it was an organic thing, but, definitely had an effect. As far as like, I think it was interesting. So, CMQ stands for Compound Money Quietly. And it, stemmed from this idea of like, how can anyone create wealth over the long haul? And, what's it rooted in? It's all about compounding. And so what you described about being on blog post 289, that idea of doing it every single week and that compounding effect, I was seeing like compounding is everywhere. When did you start to see things, like when did you notice a shift in terms of it? You were getting, whether it was people were reaching out to you or you just noticed more traffic. Was there a certain, kind of tipping point?
I don't think there was a tipping point, so to speak. Like slowly things just started happening and just I didn't, and even honestly, like since my blog views were pretty consistent from like 2018 through like early 2020. And then once COVID hit, they shot up because I was writing a lot more and there's a lot more attention on investing. And since then, I think they've been elevated. So I'm like, maybe I'm getting more, I'm getting more readers. That's one piece of it, but also like investing is also more popular. So like there's a little bit of a beta effect, market effect going on there. So it's really funny because like, I haven't done anything, like I'm just writing one blog post a week. That's literally all I've done. That's it. And it's like some of them are better than others, whatever. That's something that's special, but you just do it long enough and like it slowly accumulates. I really believe in that in a fundamental way. So
Yeah.
like there's no like one post that kind of put me on the map. I've had a bunch of different posts that have done decently well in the space, but I'm not like known for one particular thing. I do talk about a lot about market timing, and I think I've disproven a lot of the market timing stuff like definitively at this point. But I've written about a lot of stuff, and a lot of people know me for personal stuff. Like a lot of people know me for, I wrote a post about drinking alcohol and how I drink too much and stuff. And so like, trying to fix that behavior. And so a lot of people know me for my personal things. You remember me for some, posts about regrets from high school, right? It's like, it's very funny how that works, how the pieces that aren't even about finance are the ones that might, kind of struck a chord with people in a deeper way.
Yeah. It's almost like there's a need or a desire for or people are seeking authenticity. And there's so much of the world in which we all operate in, online, social media. Everyone's kind of to some extent putting on a facade. And I think when you come across something, it's like if it's real, you recognize it, and it stands out. And so then if you can back that up with where your actual product is super strong, like as you were saying, you've been able to disprove things that are have been kind of conventional wisdom in investing. I think that's. I'm a marketer at heart, so I always look at like it all comes down to offering value to the market. When you've got that down pat, it's like anything else you're doing to bring people into that. It's it's fair game. The problem is most people can't find the way to either articulate those real experiences, or we all have that doubt, like, oh, do I want to put this out there? I think it takes some guts, and also just finding that where your true self can come through. But it's very cool. And I think I remember, I want to say it was your post about, was it dollar cost averaging, and just why that is always the better move. And I'd love to, if you could talk about that a little bit, I'd love to just, echo that here.
Yeah. So that post, I'm guessing, I'm just going to assume this is the post you're talking about. It's called Even God Couldn't Beat Dollar Cost Averaging. And
yes.
That post actually made it into the book. It's chapter 14 in Just Keep Buying. So it's in the book. And the basic premise is like, let's say you have two strategies. You can just buy every month, dollar cost averaging, it's kind of like you would in your 401k or something. Or the other option is you can hold cash and then you get to buy it every dip. And I'll tell you exactly where the bottom is in a dip. So what do I mean by the bottom? Like, let's say the market's at an all-time high, right? And then let's say there's going to be a dip over however many months, we don't know. But I'm going to tell you, you just save cash from that high. And then as soon as there's a dip, you buy at the exact bottom every time. I'm like going to make you God. You're going to know exactly when to buy, right? And then you start saving cash again until the next dip, right? You just keep doing that over and over again, right? And if you follow that strategy, you're saying, oh, God, you can't lose with that, with the buy the dip. You can't lose, but it's actually, you lose, like, I think it's like 80% of the time. You lose in most rolling 40-year period. It's kind of wild. And it's like, well, why is that possible? It's because over a very long time period, like dips. So it's because dips are rare, and big dips are especially rare, right? So like even the dips that happen, they're usually so small that by the time you buy that dip, it's usually at a higher price than what you could have bought previously, right? So you're like, imagine the price is 100. This is a very simple example, but it'll demonstrate it. Price is at 100. Let's say the index doubles to 200. And then it drops 20%. So, 200 drop 20%, you drop to 160, that's about 40 down. So you're down to 160. Yep. And then so you buy at 160, right? You're like, I could have bought at, you're buying at 160, but you could have been buying at 100, 110, 120, right? So the average price would have been lower if you just bought every month versus waiting for that big dip, right? And so that's the basic premise of it. And once you understand that, and I think there's a lot of ways we can kind of keep unpacking this, but basically dips occur, but by the time you get to them, and you have to time them perfectly too. And so by the time you get there, usually you're buying at a higher price because the market generally rises. So,
right. It's interesting, something I've in my own, quest to be the greatest investor I can possibly be. One of my epiphanies in trying to study the best investors of all time, it's a lot of the best things to do are very counterintuitive. Because your gut would tell you, oh, I can, of course I'd buy the dip at the dip, and that's going to do better than if I, did this dollar cost averaging. It seems like that would make more sense, but it doesn't. And I think that's something, I don't know if there's other examples that come to mind for me, or, the idea where, yes, sometimes you do want to take profits. At the same time, if you have something that can keep on going for a long period of time, if you can go without realizing your gain, that's going to be very advantageous for you from the standpoint that you're compounding more forcefully over a long period of time. And it's like those little epiphanies to me are like why this space and this area is so interesting, because again, it's like it's uncovering things that are just they're hiding in plain sight basically. But that's cool.
Mhm.
Have you found that you mentioned earlier that just with the COVID and the pandemic and more people being involved in investing, of course, the Wall Street bets movement. Have you found from the newer investor that, like, let's say the Gen Z? I think you and I are millennials, not to categorize
Mhm.
ourselves here, but
Mhm.
we were when we were millennials, everyone was calling us out. We were the most labeled generation ever.
Mhm.
But with Gen Z, do you find are they making the same mistakes that millennials made and I'm sure Gen X made, or are they, with the information they have at their fingertips, including a blog like yours or books like yours, is that something do you have any insight there from just kind of observing the new generation?
Yeah, so I don't have much data on that, and I could definitely look into it. I just don't know much about that, like their particular buying habits. I mean, I think everything's becoming gamified, and I think it's millennials that are getting pulled into it too. And so, like, generally, young people in particular, I believe young men are more prone to taking these risky, investment behaviors. So, I think this has nothing to do. Like, I'm really not one of these people that believes like there's huge generational impacts. I really don't believe that. I believe people are generally people, and so things that are going to appeal to Gen Z are going to appeal to the millennials. And so everyone tries to market like, oh, like we're all a monolith in these generations. I think it's very silly. I think there's probably more similarities between a male Gen Zer and a male millennial than there is between like a female Gen Zer and a male Gen Zer. You know what I'm saying? Like, I
Mm-hmm.
think there's more similarities between other characteristics than what time you happen to be born in history. So, of course, there are effects. To say there aren't, like, social media has effects on people and how you view things. So there's definitely effects there, but I'm not sure if that's true in the investment space. And so I just don't have enough data, to be honest, or I haven't seen anything on that that covers it. So I can't speak to it, but I tend to believe my prior is that it doesn't matter as much as people think.
Yeah, I think that's fair. I always reference this at times where you have there's chronological age and then there's cognitive age. And so
Mhm.
sometimes, the tendency to even group people by demographics from like a market segmentation side, you could have someone who's 65 years old. It's, like Madonna, who's, who's living like she's, 30, which
Mhm.
extreme example. And now I have that image in my head of that, like New York Post, like Madonna gets fillers and I want to throw up.
Mhm.
But, yeah, it's a good point. It's something I've noticed there's been, because I've seen, if anything's different, it's the reliance on social media as for getting advice or ideas for investing. I think that's something millennials are doing it, but Gen Z seems to be even a little bit more inclined to, kind of get the 101s from, places like TikTok. But I was reading there's an Investopedia survey that I don't remember when it was published, but it was recently. And I was curious your thoughts on this. There is across generations, there is a belief that in the next 10 years, the best performing asset class will be cryptocurrency. And this is always a fun topic for us because, I love to, kind of test the metal on crypto. We're not anti-crypto, but I'm also, I think Kathy would say that Bitcoin, we believe it's going to go to $1 million by 2030, things like that. I find to be a little bit, I kind of roll my eyes, but what are your thoughts from the data standpoint, or just in general as someone who's in the space and who cares about this stuff? Where does crypto fit in?
I mean, honestly, the data on crypto is, I mean, mostly useless because, I mean, everything you look at, it's going to tell you buy more because look, it went up to the right so quickly. So, like, I mean, honestly, like, because the data set's so small, we don't have a good comparable. There's no comparable of something like this ever, like a new asset class being born like this. It's not like it's an existing asset class that we've securitized in a new way. That's not it. It's not like mortgage-backed securities, which are like an old asset class, real estate being packaged differently or being diversified in some way. This is a completely new thing, and I can't imagine. I'm guessing maybe a gold rush, but gold's been around longer, so I don't know
Right.
what it really is in that sense. My whole take on it is like the only prudent way to do it is to get off zero, I believe, because just if it does go to a million, like, you're gonna feel like
Right.
an
Right.
idiot if you
Right.
don't own any. So, and if it goes to zero, I don't think it's gonna go to zero, by the way. I think that's very, very unlikely given everything that's happened. I mean, maybe it doesn't go up in more any value and it just stays kind of jumps around at different values for the next decade. Who knows, right? Maybe it stays 30 and goes to 20, goes up to 60. Who knows what it does, but for Bitcoin at least. Um, I think the prudent thing to do is just keep a small allocation and wait and rebalance. If it's going up and it's getting too risky for you, start rebalancing out of it. Like, that's a simple way to do it. You'll make some money. Yes, you're not going to be the richest person ever by doing that, but I mean, how it's really the question you have to figure out is like, how much money do you really need to live the life you want? Do you need a Bitcoin to go from 40,000 to $1 million a coin for you to live the life you want? I think for a lot of people, the answer is no. I think you could get there by owning other things that are much less risky. So let's focus on what's important here.
No, it's a great point. I was talking to it was actually our audience today. It's weird for me to say it like that, but something that's helped me it keeps me from doing, I think, stupid things is remembering what is my long-term goal. And I kind of equate my goal to what is the average annualized return that I want to achieve over, let's say a 20, 30-year period. And what strikes me as, almost like an epidemic is the fact that over a 30-year period, the average investor underperforms the market by anywhere between, 2 and 5 percentage points, depending on what study you read. And we think about the compounding effects of that, and it's people are missing out on a lot of potential wealth. And I think going back to just this idea in general, those tendencies to take those huge risks, I think are more likely to happen when you lose sight of the actual what you're trying to make happen for yourself. You don't have to be be in a rush, and two, go try to swing for the fences on something that you don't fully understand. But on the crypto side, I think I really appreciate, because I kind of tiptoe around it. Like, I don't want to offend the crypto crowd too hard. I mean, I've made money on Bitcoin and things like that, but I looked at it as luck. I didn't have any special insight. I just was like, well, I'll try this out. But what strikes me, I don't know if you've noticed this as well with your content, is there's like this army of bots around Bitcoin, and there's no other asset class where you post a YouTube video and like the bots are so sophisticated now. It's just there's so much. There's just so much. I don't know what to call it, nefarious, but there is a certain element involved that I just don't know where it heads. From that point, like I get worried when I see people pile into it, or I've heard people say, I'm 50% Bitcoin and things like that. That makes me uncomfortable. But you sort of like you can't get people to do what they're going to do what they're going to do. And I like that from the data standpoint. It is so new, and that's where everywhere you look, everyone says, "Oh no, this is going to be the thing. It's a sure shot." But I don't know. On a separate note, more of like news right now. What do you make of Elon Musk in the trying to buy Twitter?
Yeah, I don't think it's real. I think it's more misdirection. I would say like he's like the Wizard of Oz, back there, like doing his thing. Like I have no idea what his real end goal is, and people can guess. People say, "Oh, he's trying to do this to get his back, the SEC off his back, this and that." I don't think he's serious about it. That's me. I mean, I don't obviously know the man. If I knew him, maybe I'd feel differently. But I'm going to join the board, and then I have to do a background check, so I'm not joining the board, or I have to do this or that. So it's all over the place, right? So I don't know if I mean, it's entertainment. That's what it is. It's totally. For me, it's entertainment. So, do I think he's going to try and actually buy Twitter? No, I don't think so. It's just, where would he even get the money for it? 50 billion. He's going to sell a bunch of his Tesla stock that would crater the price. It would just be a disaster for him to actually physically liquidate and do that. Or which bank's going to give him all this money? I don't know. I guess some banks might, but yeah, it's a lot. So
yeah, I heard someone say, again, everyone's coming up with their explanations for it. That no one knows the real reason. To your point, that he wants to sell a lot of Tesla stock because he knows it's overpriced, and so this would be his excuse to do it. I heard that angle.
Yeah, but he's going to tank the price, right? If he does that,
right?
Like if he has to sell $40 billion of Tesla stock, like it's gonna crash very, very badly. Like, it's a lot of money. It's a lot of Tesla stock, right? So, and especially they know he's selling. Yeah, it'd be interesting. So
now, do you follow individual names? In terms of your own investment approach for something like Tesla, rather. With your background, I see on Twitter so many different. He's such a lightning rod in terms of people say either Tesla is going to be the greatest company in investment ever of all time, or this is Enron. So I personally just I kind of know where I know what I don't know, and so I have no clue. Do you have any personal take on that, just from what you see? I know you mentioned it's a bit of a misdirection, or could be. I think he's done that in the past, but not to say that implies Enron. But thoughts on, is Tesla relatively fairly valued?
I have no clue about that. I don't follow individual names. I have a whole chapter in my book called "Why You Shouldn't Buy Individual Stocks." And I do have 2 individual stocks, but it's like 1% of my net worth. I do it for fun with friends. It's not something I'm serious about. But in terms of Tesla, like if we think about it, like, I don't know. I mean, whether it's fairly valued or not, like it's one of the most difficult questions. I think what's so interesting is because Elon is so charismatic. He can make his cost of capital kind of like negative in a sense. What that means is like he puts out a Tesla tequila bottle and raises $200 million like that. He can just print money when he needs it, like just by being charismatic and coming up with these crazy ideas, and people like them, and he just raises money. So his devout following will give him money for anything. So it's almost as if he can fake it until he makes it. I'm not saying Tesla's a fake company or Enron. I think that's a little extreme, but I also think like it's to be the greatest company ever is a little extreme too. And so it's probably somewhere in the middle, and figuring out where that is, we're kind of, going to figure that out over time. Right. So I think I try to take a little bit more balance here. And of course, people are saying like, oh, they can't deliver this. They can't do this. They've been saying that for a long time, and Tesla's still here and they are delivering more cars and stuff. And so I don't know what to say,
No, so your point about, I think, the discipline of not getting into individual names, where did that come from? Was that something that you felt you sort of trained yourself to be and behave like that? Or I'd love to hear because a lot of people, we know that's usually a bad game for investors, individual investors, is to try to pick stocks. Like it typically does not end well. Even if it's not the end of the world, every study I've read shows that, the more we're trading, the worse we do long term. It implies a certain level of overconfidence, which always is a killer for us as investors. How did you come to that realization, and how do you stick to it?
Yeah, so there are three things. The first one I heard is probably what your audience is familiar with, which is just like looking at the data on terms of whether people can beat the market. And so like you look at the data, there's these reports out there called SPIVA reports, SPIVA, SPIVA. You just look them up and you'll see like most active managers, which are stock pickers, after a 3 to 5 year period, like 60 to 80% of them, it depends which market you're in. So let's just say 70% of them can't beat their underlying benchmark. They can't beat the market after fees. And this is true of almost any equity market on the planet, right? So that's one fact. So most people know that already. Oh, they're more likely to underperform. That's one piece of information. The second one I came across, which I didn't mention in the book, this is not something that was mentioned in the book, but it's kind of, I think, kind of realized it separately, is once you start picking stocks, you start to identify with them. And what do I mean by that? So when you buy the S&P 500 and it drops 5%, you don't look at yourself and say, oh, I'm such an idiot for buying the market. No one's going to think that. No one's going to think they're foolish for, owning the market portfolio. However, if you start, hey, I'm going to buy Apple, I'm going to buy, Tesla, I'm going to buy this, and those drop, now you can feel like an idiot while the market's not dropping, that is. You can feel like an idiot because you deviated from the default choice as an investor. So I think that's what's kind of a big takeaway there. It's like, okay, so now you're identifying with your investment. So that's going to mess with you as well. The third most important thing is that there's like an existential problem here, in the sense that like, how do you know if you're good at stock picking, right? Like in most things in life, you can usually tell if you have some skill. Like if I went to a basketball, I keep using the same example. If I go to a basketball court with LeBron James and you didn't know who LeBron James was, and you watched us play, but you know the game of basketball, you within minutes, you'd be like, okay, that guy's clearly better than that guy, right? You just know, you can identify skill. You don't need to be a basketball coach. You can just kind of identify skill, right? Same thing with a lot of endeavors. You can kind of identify skill relatively quickly, right? I mean, people can get lucky, but within a couple hours for sure, you should know skill within a lot of things. But within stock picking, how long is it going to take you? A day, a week, a month, a year, 10 years? I mean, I could even argue after 5 years, you and I could pick a different set of stocks, and we can just wait 5 years. And just because mine's higher doesn't mean I'm a better stock picker.
Sure.
Like you could have just been wrong for the wrong reasons. You got maybe some weird thing happened at the end and caused your portfolio to drop. That's like completely, like, let's say you had one big travel stock that did really well, and then COVID hits. And then, so I'm saying there's so many ways in which it's hard to judge skill. So if you take those three things together, performance, identity, and then the existential piece where you don't know if you're good at stock picking, you're going to start like, why should you even do this? Like there's so many reasons not to. And so like, I just don't dabble in it.
Well, it's funny you say about identifying with stocks. I mean, I'm an Alibaba shareholder. So I just let people know that I don't identify with it. Got these on the street. I was like, we kind of have an internal joke because of, Charlie Munger, obviously the Alibaba debacle. It's not just for him, but it's been a perfect example where I was joking, and this is a joke, but there's a lot of truth in it, that, it's for like a value investor, Alibaba was like Dogecoin. It was like people were so proud to talk about it. And it was like, because you do have this sense where, you identify with it. And I think there's that, it becomes like community oriented. And it's the same effect, but to a different degree with, some of the crypto altcoins, and it's just human nature, I think, to some extent. And you're right, that can cloud your rationality. Your third point there, just about, and refresh me, the third bullet, and I'll probably
was the existential crisis. You don't know if you're good at stock picking. Like, how do you know if you're good?
The idea too, so kind of on the opposite end of that spectrum, trying to find if someone is a good stock picker, or, you can't tell the difference. Like with Cathie Wood's portfolio, I think it was interesting for me to see, like, just historically, Cathie Wood had this incredible run. Like if you'd invested with her prior to COVID, I mean, have a statue built of her, just to like worship every day because you'd be so grateful. But then, as I was digging into this and noticing more of the media, the star stock picker, the Wizard of Wall Street, the next Buffett, all these kind of things, I was doing my homework on just, has there been Cathie Woods before? And of course, it didn't take me very long to realize that yes, in fact, there has. And it's not her fault, but there's the halo effect, and then these managers who, let's say you were managing 5 billion, now you have 50 billion, so your strategies doesn't scale the same way. What do you make of? And I'm not looking to like say anything inflammatory or anything like that, but just what do you make of that kind of phenomenon of a Cathie Wood?
I mean, these people definitely exist, and so I think in the book I talked about this. They basically found there was a study where some research found like roughly 10% of stock pickers have skill, right? So they exist. Like I don't think to say that Cathie Wood has no skill, I think would be false. I think even people like, well, look, it's fallen all. Like she obviously she had a big leverage bet on certain types of stocks, and they went really well. And that's why her returns are so great. But then obviously they've had a big crash since. So I still think she has skill, but the question is she the next Buffett? I don't know. And then even saying that the next Buffett is such a weird thing because like the environment's changed, the game has changed. It would be like trying to compare like, I don't know, like could Babe Ruth? That's the question I have. Like, if Babe Ruth was playing in the MLB today, would he be Babe Ruth? And I don't know if the answer is yes, right? Because like the competition's gotten harder, right?
Can you imagine Babe Ruth on roids?
Yeah, I mean, just think about like how different things are. Like in that sense, like Warren Buffett literally could have bought net nets. And I don't know if what your audience know what net nets are, but those are just like you take a company, you sell everything off. Let's say a company is being valued at 100 million, but you bought the company for 100 million, you sold all the assets, and you have 200 million. That's like buying a suitcase for 50,000 with 100% certainty, knowing it has 100,000, right? That type of stuff was common. You literally could just get like some sort of newspaper or something, or get some sort of data information, and literally Moody's, whatever, go through the book and find 50 stocks like that. Today, you'll almost never find a stock like that. And if you do, there's probably a reason why it's like that. So that's the difference. It's like to say like the next Buffett is even kind of misleading, because Buffett was just like, he was just a revolutionary. He was one of the first in the door to do this stuff. That doesn't downplay his skill, doesn't do any of that. I'm not trying to downplay his skill or anything like that. I'm just saying the game has changed a lot. So for someone to be the next Buffett is like a very interesting thing. But yeah, these people exist. They're real. I think it's tough. And even, I mean, Baird did a study, even the best money managers out there, they underperform for a period of, 2 to 3 years. It happens. Like all of them have had periods of underperformance, at least a year, some for 2 to 3 years before they have a big comeback.
I think it was Howard Marks in his book. It was the most important thing. I think he said you need like a 55-year track record to really judge like something where I was.
Yeah, that's crazy.
Yeah, it hit. I mean, it's like, it seems a little extreme, but at the same time, I think, when you're a new investor, you might look at past performance and assume that is you can extrapolate that in the future. And of course, like the incentives involved, where I find with Cathie Wood now, it seems like she's so, she's saying now she's, no promises, but our research says 50% compounded annualized returns over the next 5 years, which to me, it's like, to go promise that, I wouldn't be able to sleep at night personally. But I think she has that. She's very persuasive, and I think she believes what she's saying. But at the same time, I don't know her either. It's not from your book, what are for a new investor, if you could go back and talk to yourself when you were, let's say 20, and just give yourself 3 ideas about investing that you need to take with you. And if you follow this, you're good money. What would those ideas be? And I'm sure you talk about them in your book.
Yeah. So in the first chapter, I discussed this, and actually, there's only one idea I would tell. If I was 20, I would just tell them one thing. I would say, don't worry about your investments at all. Focus on your income. And I give an example of why this is true. So there's something called the save invest continuum. And basically the idea is everyone's on this continuum, and I just need 2 pieces of information from you, and I can tell you where you are on the continuum. Right. And so the first piece is like, okay, how much money could you save in the next year? Whatever. So let's say you can save $500 a month, next 12 months, that's $6,000. So that's your first number. Okay. And the next question is, well, how much can your investments earn you in the next year? Like in a decent year. So let's say you have, $20,000 invested, you're going to get a 5% return. I mean, just throwing a number out there. That's $1,000. Remember, your first number, how much you can save, is $6,000. Your second number, how much your investments can earn you, are $1,000, right? So whichever one's higher, that's when you need to focus on more. And so, I mean, obviously they're equal and you got to kind of focus on both. But right now, what does that mean? You're probably young. You can save more. You don't have a lot invested yet. Get that money, increase your savings, and then get that money and then get it invested so you can increase it over time. And another example I'll give is when I was 23, I had about, I just started my job a couple months in. I had about $1,000 invested to my name, right? In my 401k or whatever. And I was like, should I be 5% bonds or 10 or 15? I was obsessed over my asset allocation, running all these simulations, all this stuff, spending all this time on investing, right? And even if I get a 10% return on $1,000, how much would that be? $100. Yet at the same time, I was going out regularly in San Francisco where I lived at the time, blowing it on drinks, dinner, Uber. I would spend $100 in a night like nothing. So if you really think about it, the amount of time you're going to spend on your investments when you're 19, 20 years old will not have almost no impact on you compared to you just raising your income and getting more money invested. And then once you have a big chunk of change, then think about how you're going to invest. Because honestly, it's not going to matter if you could be in a 60-40 portfolio, you can be 100% stocks, you can be in 3x levered. It's not going to matter when you're 19 years old. Relative to your future self, right? Assuming you're going to build wealth, like it's not going to matter. Now you're like, well, Nick, I'm rich and I have a trust fund. Okay, well, then in that case, you have a lot of investment income already. So then yes, in your particular case, you do need to think about investments and things like that. But if I could go back and tell myself, I'd be like, close the spreadsheet, go find ways to add value, like get better at data science, maybe make a side hustle, do something else that with your time where you increase your skills, build your income. Because then once you have that money, then your investments are really going to take off. So that's what I think matters. And I think it's the only thing to tell people. I'm not trying to discourage people from investing. I'm just trying to say, like, think about the impact, like the amount of time, you can spend. Let's say you can get $1,000, you get 10% return. That's $100, right? Let's say you spend, 10 hours a week trying to get that to 20%. You actually do it. You're like, wow, I got a 20% return. What's your return over a year? It's another $100. Right. It's nothing. Right, you could earn that in 10 hours easily, less than that with minimum wage, right? So you can earn that in 6 hours of working. So there's just it makes no sense. You have no leverage in the investment market. You have tons of leverage with your income though. So
no, that's a really great way. First of all, a great message. And I think it's a true message. I know from thinking back to my 20s, in some ways I'm lucky there wasn't Robinhood. Or just the ability to kind of play those games, because I did focus on just trying to make myself of someone as of much value as I could. And I was, very obsessed with, like, I needed, I'm getting underpaid. Like, how do I get paid more? Like, that was always top of mind. And I think that, and of course you bump your head along the way and make mistakes, but to be so focused on the kind of, that's a great way to put it though. Like that 10%, you're looking at another $100, you could make that, you'd sign up for Fiverr and do a couple logos before you'd be making that. But I think it's interesting, going back to your book, what was the process of writing the book like? I know from talking to authors in the past, everyone's experience is different, but being that you'd been writing, what was the process like for you?
I mean, the hardest part was getting the structure, was figuring out like what's the book really about and everything. Once I had that, it was relatively straightforward because I've been writing for 5 years online. I know my most popular posts. I know what things have done well. And so half the book I would say is older material that some of my readers will know. I mean, if you're a diehard fan, you've read like everything I've read, then yeah, you'll know 50%. I think most of the people that even read a lot of me, they haven't read all 290 posts. So they're probably going to know 20 to 30% of it at most. And the rest is going to be new. But I think for me, it was just like, I have a bunch of this material and how do I organize it? So my book writing technique was a little bit different because I had material and I had tested it in the marketplace. I knew what was going to do well, right?
Again, you were data driven. So I can just, you're like, let me pull up my analytics here.
Yeah, I know I can tell you right now, there's a post I have still gets 60,000 page views a year. I wrote about it in early 2019, still gets 60K page and just that one page. And I don't do anything for it. I don't try to promote it. I don't say, hey guys, check it out. I do literally no marketing for it. Still gets 60,000 page views a year because it's that good. And guess what? It's in the book. So
is that a SEO or is that just word of mouth? Or a little bit of both?
That's all from backlinks. It has no SEO. I mean, the funny thing about SEO, right? So what's always interesting to me is I think the best writing out there it's not SEOable because you're writing something new that's never been searched before. It's like a new idea, right? The people that are really good at SEO are writing about stuff that everyone's searching for. The kind of common top. It's not going to be revolutionary writing. It's useful information. Don't get me wrong. You can do SEO and do very useful stuff for people. And being useful is one thing, but being trying to bring a new idea and make you think differently, that's not going to come up on SEO because no one's thought of it before. That's why it's popular, right? For example, Morgan Housel, who maybe many of your audience has probably heard of, Psychology of Money, right?
Yep.
His SEO is terrible because all of his ideas are revolutionary. They don't even you couldn't even search for them because they're just brand new, right?
That's such a good point, man.
So it's like, I'm going to tell you, there's people out there that are terrible at SEO, but they're some of the best writers out there because they're putting new ideas. You want to be good at SEO, you can make money doing it. And that's great. You can be very useful, but you're not going to get known as a writer doing SEO. You're going to get known as a writer for coming up with new ideas and making people think differently about their money or whatever you're writing about.
And if it's like most things now, and I think because the connectivity is so much greater, and with mobile and how fast everything is, people can just, shoot out a link to a buddy in an instant, and I think sometimes we forget, it's like the frog in the boiling water. We don't realize if we got our phones from 5 years ago, they were revolutionary then, but we'd be like, why is this thing have a virus on it? Like, it feels so slow. It's funny with Morgan Housel, the way I discovered him was, I believe it was one of the posts on his, if it's his VC or the VC where he works, about, it's like, basically you need to keep running. And it was about how, the world, everything's changing. It was this really great example of, just combining a lot of models from different disciplines. And, he had a great reference to history, but that put him on my radar immediately. And sure enough, when his book came out, I have his book actually over here. I read it, and we have a little private newsletter I shared like my notes with. And so I thought it was a very good read. And it's definitely a book that, like yours, I think people of all ages would benefit from reading, because it's, there's lots of classics, but these are like going to be the new classics. Now that you are obviously you were an author before, technically, with your site and your blog, but now that you have a book, how does does your family treat you differently now that you're author? You know what I mean? Like, are you going around and you're a little more dignified because, well, I'm an author now?
No. So there's two funny things that. So first, I haven't seen him in person yet, but I'm going back because remember the book came out on April 12th. And so I don't know when this is going to be released, but I'll be back there by like April 21st or something. So I'll be back there relatively shortly. That's the first thing. So I don't know in real life. The second thing is, like, I was like joking with my friends, because my mom's like, if the book does well, I want this concert ticket. If the book does well, I want this house. So like, I'm like, there goes all my book. If I make any money on this thing, my mother's going to get it all. So just letting everyone know, like, I'm gonna have to write another book to actually, earn it. So.
It sounds like you're like a child star, those like Macaulay Culkin and his parents were like, hey,
exactly.
we're gonna need that Home Alone money.
Yeah. She's like, I want to go see Bruno Mars at the MGM. I'm like, okay, we can pay for that, I guess. So like,
no, that's cool. And did in terms of writing the book, someone reached out because was it the publisher reaching out because of, your name online, or you're growing that, or how did that come about?
No, I DM them. So they know who I was. I mean, if you're in the FinTwit space and you're writing like consistently, like, and you're somewhat decent, you've been doing it for a few years, you'll be known, like, definitely by the public. Harriman House does like all the financial publishing for like a lot of people in the FinTwit space. So they'll definitely know who you are. And so they were already following me. So in the DMs, I said, hey, I have two ideas, right? For books. And they said, hey, the second idea sounds a little more complex. Let's go with the first idea. Sounds better, which became Just Keep Buying. I mean, I didn't know what the title was going to be called. I actually think, here's a funny thing. They originally wanted to call it like A Data Scientist Answers 15 of the Biggest Questions in Finance. I was like, that's like the worst title I've heard. It sounds like a magazine. Throw a little shade at my publisher, but no, I'm just kidding. No, I said, we have to think about it, and said, I'll come up with a better title. And then I said, you know what? It has to be Just Keep. Like, I just knew like this. I mean, a lot of really good writing is like distilling everything down, like taking a bigger idea and then distilling it. And obviously, like my whole book isn't just dollar cost averaging. There's a lot more to it. I talk about different pieces of personal finance, about saving. I talk about a lot of other things too. But if I could only give you 3 words, that's what I would say. If I could only give you 3 words, those are 3 words I would say. And if I could give you a sentence, I would say, the continual purchase of a diverse set of income producing assets, which is what Just Keep Buying is about. And then you can go from there. But like, you can think of everything's just idea compression, like Atomic Habits, like that's James Clear, 2 words. It's like tiny changes, big results, right? It's very easy. It's the whole idea is there, right? With Just Keep Buying, it's like, this is a long-term process. You're going to be buying when the market's up, when the market's down. It's like, that's kind of the discipline there.
That's cool. You mentioned James Clear. So I went to a small liberal arts college in Granville, Ohio, called Denison University, and James was a year above me there. So it's cool to see him, and just his name now is up there with like the Tim Ferrisses of the world, and it's inspiring. You know what I mean? Because he is definitely like, he lives that. He's the perfect person to write that book. I wasn't very close with him or anything, but the school's so small that everyone recognizes everybody. So it's pretty cool. And I think who else? Who are some other authors, or even just general, I'd say in the finance space, that you find to be, like a Morgan Housel? Is there any other names out there you think, people should be paying attention to?
I mean, I can tell you the classics like Jason Zweig, people like that.
He's the man. And like,
he's been doing it forever. Yeah,
so and then
like Matt Levine, you can read. I mean, Matt Levine stuff's not as evergreen as Zweig, but he's so entertaining. So like, there's different people what you're into, right? I also like Daniel Crosby, there's, I don't, I could talk, there's a lot of people I can talk about that write in the space. I think more importantly, the things I want to do now is try and help the younger writers. So if I had to pick two people, I'd pick Kyla Scanlon. She's young. She's on TikTok and stuff, but she does writing and stuff like that. So check her out. She's really she's very macro focused and stuff. She's really good. And then Jack Rains. So Scanlon is Scanlon, Kyla, and then Jack Rains, Raines. So those two are the people who I would say they're new, up and coming. They're younger, right? But they're doing well. They're kind of building their audiences. So if I have to give you check out those people, those are the people I follow in the space who are kind of young and up and coming. So.
No, very cool. And where do you want to go, from, not to make you explain your, what your master plan is, because I know life is not as easy to predict as that, but, it's, you mentioned, when you were doing, was it litigation consulting, and realizing, okay, I don't see a lot of future here. And now you found yourself where, we didn't talk about your day to day, but obviously with now, with the book, where do you want to be in 5 years in terms of what you're doing and kind of the contribution you're making, or I'd love to hear your thoughts on that.
No clue on that. I mean, 5 years ago, if you told me to have a book out, I wouldn't have said it's crazy because I had been blogging then. So I could have, oh, that's possible. But if you told me 7 years ago, I would have had a book out, I would have said, you're crazy. So that's the difference. That one, or even 6 years ago, if 6 years ago you said, hey, 6 years from now, you're gonna be releasing your first book, I'm going to say, what? I don't even write. Are you kidding? I don't even know how to write. I hate writing, I did hate writing. So it's very funny, but what in the next 5 years, I do plan to put out another book in finance. We'll see if this one does terribly and it's just not doing what I thought. The feedback I'm getting so far is good. So it's been very good, but maybe those are just my friends, and who knows, right? It's you got to wait. I got to let the marketplace speak for a while, see kind of how it goes. And if it goes well, then I think I'll put out another book. I do have one other big idea I want to talk about in finance. And after that, I'm not sure. So just day at a time, kind of figuring that out. So
yeah. No, I think, something I feel like with the content, trying to think of how this kind of content, and you're a great example of it, but how can these really good ideas that are earnest, that will help people if they learn them and internalize them and apply them, how do we help those ideas reach more people in a way where they're receptive to them? It doesn't feel like they're being talked down to. It also feels like there's no perverse incentive involved. And I think about the media content and just how I could see, I'm not trying to give you career thoughts or whatever. I'm just thinking out loud here. The content on Netflix, where everyone's streaming, everyone's watching everything. And there's just, I don't see a lot of content around this space that's in that format, and maybe I'm missing it. Maybe the algorithm isn't serving it to me. But I could see that being such a great way to, help further expand and grow these ideas and help them spread around more and more and more. Because I think that's what's so critical. And I think your data-driven approach, it resonates because people who know things know that even if they don't know anything about money, they know that the data matters and data counts, and that's, you can't argue with it, right? It's like a DNA evidence, and but at the same time, there's so much, I don't want to say misinformation because that implies something else. But there's just a lot of different incentives and reasons, a lot of confident people telling you to do things that aren't necessarily in your best interest. How would you recommend for someone who's younger to kind of filter that out? What would they use to filter that so they avoid making those or falling for those mistakes?
I would say try and, find the people you respect in the space and then see who they follow. And usually if you see oh, wow, a lot of people that I respect don't follow that person, but that person seems very popular, then that kind of tells you a lot, or they're not really repping them. So I don't want to name names. Of course, I don't do anything like that, but I'm just saying there's a difference between being popular and being respected, I think, in the space. And so I care more about being respected in the space. I'd rather have the Morgan Housels and James Clears of the world saying this guy is good work than having a million more people reading my work, right? Because for me, that's what really matters. Because if I'm the people who are legit, who I think are legit, think I'm legit, that's more important to me than being oh, I could sell out and make a lot more money. And that's just it's not how I am. But that's just a personality trait possibly, but that's just what I'm about. I'm not about that type of stuff.
Sorry to cut you off. I think that's a good example where whether it's a personality trait or not, it's recognizing that, you want to build things that last. And a lot of people will chase that immediate thing at the expense of the longevity. And going back to your point about writing 280 something blog posts and, just the continuous chipping away, that's how things really grow. And that's how things that sustain, if you want to grow things that actually can stay there and they don't fall apart when there's, a breeze. And I think that's just a great reminder about, in the short term, sure, someone could say, hey, you could be like Ty Lopez and, show your Lambo, and, you'll get a lot of, sorry, Ty, if you're watching. Ty's a big fan of the show, I'm sure. Completely kidding. Ty Lopez has no idea who I am. Anyway, but I think that's it's hard. I think that is something that's inside where you could easily, it's hard for people to delay gratification like that, especially when there's so many shiny things you could chase after, do something, you could do TikTok dances and explain how it's data driven, but
Yeah, I mean, it's just like, yeah, like a lot of that stuff. I'm not going to do that for engagement. It's not about that. I barely even I mean, the marketing I'm doing more marketing than ever. So this feels weird to me to be like retweeting a lot of stuff and like it's all about my book and stuff. And like it feels weird to do that, but like I'm kind of getting used to it now because I don't really do it. Here's my normal thing. Tuesday morning, I post my blog every week. I send it out at whatever 8:30, 9 a.m. Eastern time, and then I retweet it at noon to kind of get the people who are on the West Coast. That's it. That's my marketing every week. And then obviously I post on LinkedIn. I post on MailChimp. That's it. I don't market a bunch. I literally just put my stuff out there, and that's it. And because you know why? Because the people I like follow, like Morgan doesn't market a ton either, and he's done very well. So it's like I follow their social cues. Like if your work's good enough, like it'll be shared. Like people naturally are going to share it. So I care more about quality. Where I put in the work is like at the keyboard, like over the weekend, I'm putting in the work like that 10 hours to get that one blog post out. That's where I'm putting in the work. So
no, that's it's a good reminder too, because it's like we can only do so many things really well. And if you're trying to be, marketing is a craft in itself. So it's like it's an important reminder. Just on like more high level things that are going on right now. I know you mentioned macro. I assume you don't pay a ton of attention to interest rates or what, you don't try to make predictions about what the Fed's going to do. I don't find any value in that either. And I enjoy having that debate because to me, it makes no sense. So I think by your reaction there, I think we're on the same page.
Yeah, we're on the same page. I mean, the one thing that is true though is like, for example, the yield curve just inverted, right? And the yield curve is a pretty good the data, according to the data, like stock returns will probably be lower than average, than historical average over the next few years because of the yield curve inversion. Now, of course, maybe this time's different, right? But that's generally true. Every time it's inverted, it hasn't done that well within the next 12 to 24 months. However, you're like, okay, Nick, well, that's true. That the data showing that. What can you do? You're like, okay, I'll just move to bonds. Bonds do much worse than stocks. Bonds do worse. So you're like, okay, I'm going to try to go into non-risk. I'm going to go hold cash. Cash does worse. So it's like, you're between a rock and a hard place. You got to just eat the bad returns or the subpar returns. There's nothing you can do, right? That's true when inflation's high. That's true when yield curve inverts. And so, I wish I could be like, oh, we can be tactical and do this and that. But if that was true, like, everyone would move already. It's like, it's almost like it's one of those arbitrage things where like there's an obvious arbitrage you could always do, then it wouldn't exist anymore. Because as soon as that happened, all the algos would have traded it and you would have lost their chance, right? So trust me, there's a lot of people that have done these analyses already, which means like a lot of these like tactical decisions don't always work. There are some that could work with like moving averages, and I've seen some data on that. And they probably do still work to some degree, but that's debatable, right?
It's so. By the way, it's almost validating. Like these are things I've come at this from like an outsider perspective, and I've had these epiphanies where I'm kind of looking around like, does anyone else notice this? And I have a lot of confidence in what you're saying because I know the thoroughness in which you're the approach that you take, and so I know you're much more of an expert than I am. But it's just super refreshing to hear or see your response like that, because I've had those same thoughts. It's like the more you move, the more you lose. Like there's very little advantage to being I'm gonna hop in here and go over here, and this idea that we can predict the future with any sort of certainty. It's like I try to focus on what can I actually control. And what I can't control, I shouldn't pay too much attention to it because it's going to make me do something stupid. And I just find, these ideas too, like with I see all these, I get my ads now are all like, hey, my swing trading course. And it's like, if you had something that really worked, you wouldn't tell anybody about it, because as soon as more people do it, it's self-defeating. And it's like those kind of big ideas where I feel like it's a very obvious thing, but it fools a lot of people. And I don't know if they're being fooled or it's just the human desire to get quick money.
Quick. Yeah. Get rich quick. Exactly. It's like, why would you charge, you're going to charge me $1,000 for this course when you can just make that like in a couple because you can't make that in a couple of days. And it's the profit on the course is much bigger than the profit you're going to make in your book. Yeah. Otherwise, why would you waste the time to do it? Right.
Give it away.
By definition, you're like, and you're saying, and if maybe you could make the $1,000, but maybe you have 10 people in your course. Now it's $10,000. So now, even if you could make the 1,000, the 10,000's higher. So maybe even you have the skill, but like, it's still better to sell the course. Right. So it's like one of those things where it's very interesting, but yeah, I mean, I try not to do, yes, I'm selling a book, but it's like, with inflation 8.5, I think it's like $14 right now. I don't know what the price is by the time this thing comes out, but it's like $14. Inflation was 8.25%. Like it's like I'm just, it's like it's almost free at this point. Really, the cost of the book is your time. Like if your time, if it takes you 6 hours to read it, and even if you're making minimum wage 6 times, like let's say $15 an hour, like that's $90 of your time, right? The $14 is nothing. It's really your time that's the most valuable piece, right? So when you think about a book,
our audience is big time books. And the Charlie Munger quotes about, he's such a promoter of reading all the time. And, early on I'd post we went through every Berkshire meeting and found every book that they recommended from like 94 on, and turn that into like just like a little lead capture thing where, get the list basically, for your email. And, it blew me away how just like people were gun ho on it. And I mean, every time I do a live or anything, it's like, hey, what are some good investing books to read? So, it's cool. That audience is out there. So I think it's sweet.
And I think the interesting thing, I'm just doing a data-driven guide, or I'm trying to be like, here's what the evidence says. We're not just doing belief and conjecture on what you're talking about, these confidence people who come in here and just sound good. Like, it's like, I'm very confident in my work because I've looked at the numbers, and it's like, it's not an opinion. I'm just like, okay, here's what the numbers show. And like, here's my interpretation of that. Right. And so like, of course my interpretation could be wrong, or the data could be wrong in some way, but I generally think it's not. I mean, usually there's multiple sources that are kind of pushing towards an idea. If I just have one data point, it's usually not that good, but yeah. So I'm definitely down for any of that. Question for you. What's your favorite Munger quote? Do you have a favorite or no? Or if you had to pick like a handful, just which one comes to mind? Is that your favorite? Maybe it's top five.
The best way to get what you want is to deserve what you want.
Okay.
That one, when I started my business it would have been 2016, I had a wall calendar at the time. And my idea was like, I didn't assume that I knew in New York City, it was starting a marketing company. I knew how competitive it was. But I still had that kind of like a youthful ignorance of being in my late 20s, or I think I was like 27. So now I'd be like, I don't know about starting a company like that. It's like there was a certain level where the ignorance helped me. But every day I would just, if I felt like, did I deserve, my goal was, I was like, I want to do what I love and do it profitably, and that's success. Like forget the actual, how much money am I making per se? And so what I found was every day I'd ask myself, did I deserve that today? Like, was I deserving of that outcome? And it was more of like just a feeling, because I'm a hard worker. I'm sure you're a hard worker as well. Like we live in New York City. It's kind of like that you have to be here. And I would just exhaust myself, and I loved it. I was so energized by it. And it worked. It really worked. And it's one of those things where, like there's always a little luck involved, right? That's the way life is. But in terms of, I always knew, no matter what happens, I never want to look back and say, well, I wish I had tried a little harder. And that quote just really stuck. And it's, I think he's elaborated on it, which is like, why would the world's not a crazy enough place to reward a bunch of undeserving people. I mean, it happens, but I look at that as more like a statistical anomaly than that's, because you could point out, well, look at this person, but that's just randomness. Generally speaking.
I agree. Completely agree.
How about yourself? Are you, not to put you on the spot on the Munger quotes, but.
Oh no, I know my favorite. Invert. Always invert.
Yeah, that's
it's a great idea, right? And my favorite one is like, I think I wrote this post on the Vanderbilts, and it was actually did really well. It's not I do talk about the Vanderbilts in the book a little bit when we want to talk about lifestyle creep, but what I was talking about this one is like, imagine, like I said, you had to instead of saying find out how to get rich, like let's find out what's the best way to go broke. And so the post was called The Best Way to Lose $5 Billion, because that was like how much that's roughly their net worth when you adjust for inflation. It's probably more than that, but whatever. That's just what it said, $5 billion. And so like, what's the best way to lose $5 billion? And so I start with the Munger quote, invert, always invert. And then I dig into what they did. They spent tons of money. They never owned income producing assets, all this stuff. And I actually think it's a big piece of the book. So in chapter 11, I talk about, income producing assets, but I really say is like, there's no one right way to get rich. Like there's this great quote, like there's only a few ways to go broke, right? There's really like, high risk, high spending, right? The leverage. There's a handful of ways where you can go broke, and they're very well known, and most of them involve risk and high spending. But getting rich, people get rich in real estate, people get rich in farmland, people get rich in stocks and individual stocks, index funds, all sorts of stuff, right? So I think that it's that line from Leo Tolstoy's Anna Karenina, which is like, all happy families are the same, but all unhappy families are unhappy in their own way. It's the reverse. So like if you invert, always invert, right? So you invert that, and it's that, all rich investors got rich in their own way, but all poor investors were the same, basically, right? Like, or kind of, you can think of all poor investors are the same, all rich investors got rich in their own way, right? So it's kind of like that's the idea there, and because of Munger and that principle, and you just invert them, like inversion works so well in so many circumstances, and it's like, oh, that's actually kind of cool. So
That's such a great point, and it reminds me of is it, I forget his first name, Ellis. He wrote the like winning the losers game.
yeah,
Um,
Charlie.
yeah,
Charles
Ellis, right?
Yeah.
And I think in that sense, because I love when I've in this process, I'll have an epiphany where I'm like, hey, I think I figured something out, and then I'll buy a new book, and in that book, I'm like, oh, they figured this out 20 years ago. But he had made that great point about if you're, generally if you're just an individual investor, it's about avoiding making a lot of mistakes or even repeat mistakes, but more importantly, avoiding like the catastrophes. And something that I did, like because of Munger in part. I think I was listening to, I'm sure you know who Peter Kaufman is. He was in a lecture, he was talking about, he wrote Poor Charlie's Almanac. He's the,
Oh, okay.
Glen Eyre. He was on the board of the Daily Journal. He gave this lecture that someone they listened to, or someone taped it. And he was talking about how at one point he realized there's Discover Magazine. They had interviews with, basically if you're a scientist or in that field, you share like everything you've learned in your interview with Discover Magazine. He said, if I want to add a lot of models to my thinking here, that would be a really interesting way to do it. And so he got every single interview, printed it out, and he'd go to like a coffee shop every Sunday and just comb through it. And he said, he'd skip over some of the stuff that was just way over his head. But as an investor, he started to see things like, oh, that's just like this, or this reminds me of this. And kind of like this biological nature of business, I think is interesting. But in that, I found the articles, like I'm kind of like, I jokingly say Detective Franco on the case. And I found the PDF, and there was one with a interview with a guy named Robert B. And Robert B. is known in professional circles as the master of disaster. And he has been studying like human tragedies and system engineering failures for over 6 decades. And so I'm, in this interview, he's like, the root cause of all disasters is this. I'm like, I'm listening. Hubris and greed. And when we think about financial disasters, it's all rooted in the same things. And so, going back to inversion, what would I want to avoid the really big mistakes? It's like, one, make sure I'm not overconfident, like humble yourself. And then, the greed factor. I think, selling my Bitcoin when I sold it, I was just like, look, don't get greedy. You got lucky. Like just take, this is the time to take some profits and just get out of this game. But I think it's been so helpful, and it goes back to inversion to some degree anyway. Yeah, it's funny with the Munger page, and I know we're a little over. I don't want, if you've got to jump, I don't want to hold you.
No, I'm good. I'm good. We can keep chatting.
It's like 11 p.m. I'm like, and that's the reason I think. Going back to the Munger stuff, it's funny because he's such a eccentric person, and I appreciate that. But I don't know if you caught this controversy about the windowless dorm rooms.
No. Oh no. Yes. Oh, at UC Irvine. Where was this at? UC Santa Barbara.
Yeah.
Or somewhere. Right. Yeah, it was somewhere. Okay. Yeah.
And so the billionaire amateur architect Charlie Munger, who his reasoning for these decisions is very clever, but it's hard. You need some PR to really help land that message, especially now when it's like, okay, a billionaire donated and said you're gonna take my money, but only if you build the dorm the way I want it. And the way I want it is the students don't get windows in their dorms. It's like the way that it looks, it's terrible. And he doesn't have that care to say like, well, no, here's the reason. Some architect resigned, and he's like, well, he's an ignoramus and he doesn't know anything. And but it's just funny, like seeing on one end, you get most people I hear from are, they find a lot of value from the page. But also sometimes I think like I built the dorm room. Like I'll get these, it's just angry, like, hey, where's the windows, Charlie? And it's just funny, like how the internet's a funny
trolls.
Do you encounter any of that? Just being that you're out there and you have an opinion and it might be in conflict with other people's beliefs.
Oh, sorry, say that again.
Do you ever run into not just trolls, but do you ever find like those wackos on the internet who are like, you're totally wrong and like you don't know what you're talking about? Because you have the data behind you, but I don't know. Like I know there's crazy people online.
Yeah, they have. I think when I really see kind of one of these someone comes out and says, oh, this is completely wrong, but like actually not even 99, 100% of the time they have no data to back their argument. They're literally going off of just gut. There are, I wouldn't say not maybe 99.99. There's one person in the space who's ever like said, hey, I don't think this is right, and they've actually had data, and I know who they are because one of my friends, and like so they call me out when I ever do something that they're not 100% behind. And so like, and that's rare that it happens. But like, it's one of those things where like, I know these people have no data. I know they haven't like, oh yeah, you ran this. And they're like, oh no, but if you adjust for this, I bet that's not true. And I adjust for it and I'll adjust for it and get and retweet and retweet them or like get reply to them in like 10 minutes. And then I'm like, okay, I did. That's even worse actually. Like your idea was even, I should have actually written the post on your idea because it's even worse than what, it's like, and then it's like, now what are we going to say? Like, it's like, I do this all the time and they don't
Right.
think like, I know what I'm like, I've thought of these types of things before and it upsets people. And so like, I don't know. I just think it's a lot of people just have ideas like, oh, well, that doesn't logically make sense. Like, I don't care about the logic. Like, you need to run the numbers. If you don't run the numbers, like, there's a lot of non-intuitive things, right? Like, for most of human history, we thought or not, relative history, we thought the Earth was in the center of the universe, right? And that makes sense, right? Everything's moving around us. Why would we be moving around something that makes no sense, right? So just because something's intuitive doesn't mean it's accurate, right? And so I think that's a lot of this is like, there's a lot of intuitive things in personal finance and investing that like, once you actually like dig into the data, you're like,
wrong.
Actually, that's not like, it's not what you should be doing. Right. Like, and so that's kind of, where I come back on it. And I don't worry about the trolls too much. They come in, they already have like 1-star Amazon reviews, like, worst book I've ever read. I'm like, is it really the worst book? Is it the really worst? Like, I don't really believe it's the worst book. Like, someone gave me a 4-star or 3-star and had like a good detailed, like, oh, here's what you missed. Like, I'd be like, wow, that should be useful for me. Like,
right,
but like feedback. 1-star worst book ever. I'm like, okay, here we go, trolls. Like, thank you. I must have said something that upset you, or I don't know what it was. Right. And that's it. And here's the funniest part. Find any book you love, like that you're just absolutely in love with, just go to Amazon and look at the 1-star reviews. You're gonna be like, what is going on? Like, there's just a set of people out there that go out there and just trash people. And I don't know what it's about. It's, and it's just crazy. Like I some of the best-selling books out there, and there's so many 1-star reviews. I'm just like, what's going on? Like, this is clearly an incredible book, so yeah.
That'd be a funny content series, like reading the 1-star reviews of classic books.
Yeah, it would show you that like there's people out there that just want to like cause havoc or just troll or whatever it is, or like, oh hey, I have power. It's like, the only thing that matters, like, are people reading, are people talking about it, do people actually like your ideas, and that's it. Like, I have the difference when I wrote my book versus when I think a lot of people write books is like, I have some proof of, it's like, product market fit, as they call it in the startup world. It's like, totally. I have a little bit of that within the writing space, because like I've posted these and people have said, oh, I love this idea, or I do this, or and I'd see the traction. So I can kind of say like, okay, here are my greatest hits. Like, can I weave them into a story that makes sense? And that's the idea, right? So yeah.
No, it's I like the product market fit. It's exactly right. Like, you've gotten what resonates with the market. That you've already kind of stress test these ideas and put them out there for people to kick the tires. I think it'll be a really good little piece here is, what are some of those counterintuitive things, that I know it's in the book, we'll have all of them, but just, a couple of them would be, I think a good clip to have circulating.
Yeah. So counterintuitive things in personal finance. First thing, you're probably saving too much. You're saying, well, why would you say that, Nick? How do you know that? Like, I'm looking at current retiree data, and they always talk about this retirement crisis and like, oh, we're not saving enough and retirees are running out of money. Only 1 in 7 retirees are actually drawing down on their principal. So let's say you have let's say you have $1 million or whatever, 100,000 doesn't in your account, doesn't matter, and you're getting investment returns every year. Only 1 in 7, about 14%, are actually selling down that initial principal. All the rest are either just living off their investment returns or their investment returns in Social Security. That's it. Or they don't even take all the investments out. So if your investment earns you, let's say 4% in a year, so you got $1 million, 4%, 40 grand. So they're pulling out either less than 40 grand in a year, or they're pulling out the 40 grand plus their Social Security to live on. And only 1 in 7 are actually selling below the million, right? So that's one thing that's a little bit shocking, right? You're like, what? That was supposed to be a retirement crisis. Then you look at like, most people expect like, oh, you're going to run out of money in retirement. That's this big issue. The opposite is true. You're going to probably get wealthier than you can imagine. And why do I say that? They've run simulations on this. Michael Kitces did. Michael Kitces is very legit. He's one of the most legit guys in our space, right? And he did a simulation where he said, let's say you're using the 4% rule. So it doesn't even matter how much money you have. You're just pulling 4% a year using the 4% rule. You have a 60-40 portfolio. Over a 30-year period, you're more likely to 4x your wealth than have your wealth go under its initial starting balance, right? So you start with $1 million, you're more likely to have over 4 million after 30 years than under 1 million, right? Which is like 4x your wealth in 30. Like, you're like, I'm going to run out of money. It's like, no, you're probably going to just get richer. And you look at inheritance data, like people die in their 60s, leave on average like 300K, right? 70s, it's higher. 80s, it's higher than that, right? So it's like, you're seeing like people like, I'm going to run out. All these fears we have are not backed by the data. I mean, don't get me wrong. There are people who are struggling in retirement. There's a subset of people, and we should have policies that help them, right? And so like, I'm all about like helping people, but at the same time, all about like, let's figure out where the problem is, what the problem is, and how we can address it, instead of saying, oh, we have a retirement crisis on our hands, which
Right.
is like, and
And
so
doesn't it bug you a little bit? And I don't mean to cut you off, but it just got me
Mhm.
thinking here. The way that in some of those data about retirement, where it'll use an average but not a median.
Mhm.
Like, to me, that bugs me, because I'm like, well, the median would tell me more of the story. Like, there's definitely going to be people who are like have $0 in savings, and that's going to skew things in a certain way, and it's going to create a narrative. And I think all the data shows this too. It's just, there's or qualitative data, which is the number one stressor for all Americans is money. We're all worried about it. Even, I mean, I'd say people that have money are worried just as much, if not more, because then they're like, well, how do I make sure I don't lose all this and inflate? There's a lot of like that kind of point you just brought up, of the fact that most people have way more money than they need in retirement. That's like a mentality shifting nugget of truth that, I'm not saying that we go tell people that and they're like, oh, I guess I don't have to be, I won't have chest pain anymore. But it definitely brings up a good point, which is, we do have these fears that are, while there's reasons to be, it's good to worry, you don't want to be complacent. But yeah, I think that's an issue, right? People are really stressed out about money regardless, when we don't always have to be, or at least the data allows us to be a little more cool, calm, and collected, which would lead us to make better decisions anyway with our money.
Yeah, I mean, if you also just like look at like you ask, I mean, there's this great book called like The Five Regrets of the Dying or something like that, and it's like, what's one of the biggest regrets people have is like working too much. No one, it's very rare that someone's like, you know what, I just didn't work hard enough. It's almost like I worked so hard that I had all this extra money, I can't even use it, I lose my health or something. It's like,
Yeah.
it's really tragic. And like stuff like, I meant, COVID as it happened, everything. The real tragedy in COVID is like there are people who are 60 years old, maybe 65. They just retired, living out their golden years, about to start living out their golden years, and they get hit with this virus and all that saving, all that stuff for what? And it's terrible. It's terrible to say. It's really tragic and grim to say it like that. But like, that doesn't mean you should blow your money every day. But I'm just saying, like, don't be so hard on yourself. And that's what I talk about in the book a lot. Don't be so hard on yourself. Stop guilting yourself. Stop doing that stuff. There's some data to kind of show like you don't need to freak out as much about money. Like, enjoy your life. Obviously, if you're like, well, I want to fly in a private jet, well, then you got to keep grinding. Like, yeah, you got to care a lot. You got to care about investment returns. You got to care about everything. You're trying to get to that level of wealth, right? I'm sorry. But if you're just like, most people don't need that. They don't want that. Like, they're not like, oh my gosh, I want to live this crazy lifestyle. Most people just want to live a decent life and,
Right.
have a place to live, eat good food with people they love. That's I think what most people want, and so I think you don't need all these fancy things to get there. So that's kind of my take.
No, that's a good one too. I think, it's like, to your point about there are people that are struggling to a different degree. I think, everyone deserves to have some dignity in their older years. You know what I mean? So it's like that. I think we can account for that and just, you hate, but I think we all have that fear of, the carpet being pulled out from under us. And I'm sure I've read a lot about evolutionary psychology, and I find that to be a really fascinating subject, just because, so much of our, those gut feelings are rooted in, millenniums of just development and adaptation. So, sometimes I think the anxiety that we all have, and this is not like a professional opinion, but it's rooted from a different time. We're having that anxiety, you're like, oh, there's a lion over there. Like, I should be on alert. Whereas now we have, relatively speaking, we're in climate controlled spaces, and, I'm not worried about, the outdoor elements affecting me, thank God. And, but we still have all that, all that stuff. And it manifests itself in different ways. And, there was, what are some other, just while I'm thinking here, what are some books along the way for you that were really, really important to you in your own development of your philosophy about money and investment and, just life period?
Yeah. So like for particular investing, the Intelligent Asset Allocator, William Bernstein. So anything by William Bernstein was a big influence on me. He's very investment focused and it's very technical. So I would say William Bernstein, shout him out. Peter Bernstein, it's funny enough, there's another Bernstein, Peter Bernstein, Against the Gods, a lot of risk stuff he talked about. But a lot of the things that influenced me as well, like obviously Zweig influenced me, Housel, all these people, I can name people that everyone knows. But I think one of the things that influences me a lot is reading great books not about investing. So for example, Deep Survival, that's a great book. Check out Deep Survival, or The Ends of the Earth, it's The Ends of the World, I believe it's called. And it's just about like the 5 mass extinctions in world history. And it teaches about investing in different ways, like tail events and things like that. So with The Ends of the World, and then Deep Survival is just like how do people survive and how you kind of mental states you have to get yourself in. So it's not necessarily technical on investing, but you can kind of apply it. So I think a lot of me writing, decent stuff is from like reading non-investment
Mm.
material. And that was actually when I was talking to Jason Zweig when I first met him, I said, if you had any advice to give to, a 27-year-old writer, or 20, or maybe I was 28 at the time. And I said, what would you say? He said, read a lot, but not about investing. And that's the key, because you're making these connections across different disciplines. And that's what's really helpful, because you start to recognize, like, the stock market's a biological machine for all practical purposes. It does behave like its own life force. And because we have all these market participants that have different beliefs and, time horizons, all this stuff, they're all playing out in real time together in this symphony of, chaos, basically. And it's very interesting to watch.
Yeah, I think of it as a complex adaptive system. Everything's interacting with everything else, and our tendency to see these patterns when in reality we're kind of looking through a kaleidoscope, trying to make sense of it, and like the chartists of the world, things like that. It's really fascinating. I think to your point, and this is kind of a good place to sort of land the plane, is the importance of multidisciplinary thinking. That's something that Charlie Munger, and again, this is not all about him, but he's such he gave this speech in '94 where he said, like, look, this is like how I became successful, and I don't think he thought he'd live to be 98. He was in the Coke deal had been this huge success. He'd just done all these cool things. And, he said this system where you're taking the big ideas from all the big disciplines, because, you draw those connections. You see those things that when everyone's so narrow focused on one thing, they're not seeing the world as it is. They're seeing things through their little, their specialized scope. And I know I've seen in like the professional worlds, some of the smartest people in one area, they get their minds kind of fall apart and everything else. Like they can't really hang intellectually on anything else. And then even their specialized focus becomes less useful because it's not rooted in the reality anymore. And, but to your point about just getting ideas from different places, I've always found, even before I got kind of obsessed with investing, if I wanted to spark a new idea, I would just try to read about an unrelated subject, even going on like Wikipedia and be like, I remember just being like, oh, like, when did the elevator come about? Like, what happened? And just knowing that, oh yeah, like it used to be the most primo real estate was on the first floor because you didn't have to walk up the stairs. And then with the elevator, there's little random stuff like that where it's kind of like you have these pathways in your brain that aren't getting, this is not a scientific fact or anything, but like they're not getting the blood flow. But when you do, it's like they're making connections like, oh, there's something up here. And, I think when you, as investors, if not to say go the individual route, but even just realizing these things that are counterintuitive are actually right, it's you're seeing something that others are missing. Your brain's agile enough to recognize it, and I think that's something I definitely admire with Warren Buffett, Charlie Munger, and just I don't want to be an old person that gets rigid. I want to have reasons to still have passions and interests. And there's a Warren Buffett interview that went live last night with Charlie Rose, actually, which is his first interview in over a year, and it was just he's 92 years old and sharp. Sharper than any other 92-year-old I know. And some of that's genetic, but also it's from everything I've read, he's just always reading different things, not just 10Ks, but has, a lot of interest outside of investing. So a long-winded way to say that, but yeah, Jason Zweig is it Zweig? I've always said Zweig and I'm probably wrong.
I don't know the correct, I've said Zweig, but I have no idea. So.
Yeah, I appreciate his stuff so much. It's awesome. And, even his commentary in The Intelligent Investor, it's so useful. Thank you for listening to the CMQ Investing Podcast. And if you haven't already, make sure you subscribe on Apple Podcasts or Spotify. It's totally free, and that way you'll receive every new episode as soon as it's released. Thanks again, everyone. We'll talk soon.